Okay, let's do some Q&A from Sunday's Market Outlook. A lot of good questions this week. I don't know if I'll get to them all. It is 10:30 on a Wednesday when I'm starting this. The Fed is 2 o'clock. So I got about 2 hours, 2.5 hours to answer as many as I can. Let's begin. Some low-hanging ones right away. Any thoughts on Janet Yellen's friendshoring? I totally agree with this. This is outsourcing to friendly nations. Well, if you're going to have trade agreements, like North America has a trade agreement, Canada, US, and Mexico, why not use it? Why go outside and start dealing with countries that you know that you're going to have some ideological issues with? Just because of the money? You see what it says? That you're willing to overlook a whole bunch of things for the money. So I think it makes a lot of sense. And what does North America have? North America has Mexico. Which is a low-cost labor destination place. It is in North America, and they are a friendly nation, so I agree with that. What I find interesting is that a liberal said it. Liberals rarely ever say anything with common sense in it. Usually it's all about the protected status of this minority or that minority. And if a conservative had said this, if a conservative had said, why don't we just do business with our friends and neighbors? Then would have come the cries of privilege, and this is perpetuating white supremacy and nationalism. Oh my God, I can't believe it. All these other nations of people struggling, trying to get ahead, and you want to strip jobs from them and strip income from them. Oh my God. So I think this is a good step in the right direction on two fronts. Number one, it makes a lot of sense. Globally and geopolitically, and as far as lowering risk, it makes a hell of a lot of sense. Number two, when liberals start saying common sense things, they don't get attacked. But if a conservative said the same thing, they would be attacked. If more liberals started talking like this, Tucker Carlson would be out of a job in no time. Next one. Just out of curiosity, what annoys you more, improper use of decimal places or lawyers? Well, the improper use of decimal places is just annoying. That's all. Lawyers are offensive. There's a big difference between that. And when I say lawyers, I particularly mean litigation lawyers. You need lawyers for a whole bunch of things. Real estate closings, wills, contracts, things like that. I'm okay with all that. I'm just not okay with litigation lawyers because lawyers need billable hours. Always billable hours. If you think you have a problem, you can always make it worse by adding a lawyer to the mix. Because a lawyer is, like anyone else, self-interested. They're interested in billable hours. You're just a lake that they're going to fish in. They need as many billable hours as they can, and if they don't have enough clients, you're going to make up the shortfall in billable hours. And this is a quite common tactic that lawyers use, and anybody out there who's ever had to go through the misfortune of using a law firm for litigation knows exactly or will recognize exactly what I'm about to say. Your lawyer will say to you, I'm going to bring somebody in on this that has some expertise. And the person they're bringing in is also someone who needs billable hours because they both want to make partner. So they have this agreement behind the scenes where they say, you know what, you bring me in on your cases so I can get billable hours, and I'll bring you in on my cases so that I get billable hours, and we'll double bill every client. So lawyers, because of that, because they don't have your best interest in mind and they're supposed to, I find them very offensive because when you show up there, you're hiring an enemy. They're your enemy. If you want justice, hire a biker. A biker will get you the results you want faster, and a biker gives you his rates from the top. Don't hire a lawyer. Lawyers are worse than bikers as far as criminal or being criminal is, but they hide it behind a suit. A biker, you know exactly what you're getting, and you know your rates from the top, period. And if a biker shows up at your house and says, you owe my friend money, what are you going to do? Get a lawyer? You don't want that guy coming back. Okay, when you say you will be listening in on the Lennar conference call, if you have a good source to listen into live calls, anybody can do this. You go to whatever publicly traded company that you have, Lennar.com, If they are publicly traded, they will have an investor relations site. Go there, and for Lennar, it's under events and presentations, and here it is here. Thursday, September 22nd at 11 a.m., third quarter earnings call. And when the time comes, you just click on this little thing and you'll go to a form which always asks you your name, blah, blah, and then off you go and the thing starts. Okay, was wondering if you would be able to do a similar analysis for the housing market in Canada next week, similar to what you did for the US in this video. You should be able to get that done on your own. Fred does have Canadian data as well, and all you have to do is just follow the same process I do, look for the same data, and you can come up with your analysis. However, Canada has specific markets. You have to look at the Vancouver market as being separate from the Toronto market, as probably being separate from the Montreal market, as probably being separate from the East Coast market as well, because Canada has a very small population that's spread out over a very large landmass. So you get a whole bunch of regional markets as opposed to a national market, whereas the US has a more homogeneous national market with specific regional peculiarities, but you can look at a national market in the US. Canada, I don't know that I would look at the median or the average in Canada. I'd pick a market that you're interested in, whether it be the Vancouver market, whether it be the Toronto market or the Toronto and area market, and drill down on that. So I leave that to you. You should be able to get that done. I do these videos in such a way that I'm not telling you something, but I'm basically showing you a process, and I go through the same process each week so that you should, in your own country, wherever you are, say, okay, well, I've got to look for these kind of rates. I got to look for this kind of information. The analysis, is then idiosyncratic to that particular country, but the process would be the same. Based on growth being the winner over the long term, do you believe HML factor for Femme French is not relevant anymore? No, I don't believe that at all, because it depends on your investment horizon and your level of active management. There are times where growth will outperform value, and value will outperform growth over very long periods of time. Growth tends to outperform. But why be in growth when value is outperforming? So you have to know when to rotate out of growth and into value for a period of time, and when to rotate out of value into growth. That is active management. The Research Foundation of CFA Institute's 2012, a new look at currency investing, found that 2012 were rather dated, but let's see what we have. Returns for the common FX strategies have been larger than or equal to the excess returns generated by the equity market. With the note saying comparing FX returns with equity returns requiring subtracting the risk-free rate from equity returns. Yeah, that would make sense, because an FX strategy is long one currency and short another. Well, long you're going to pay the risk-free rate, and here you're going to get the risk-free rate. So this is just a premium over the domestic risk-free rate, so you would have to, for equities, look at the premium as well. Sharp ratios for common strategies are clearly higher than those for equities. Downside risks are smaller than for equity markets. During periods of extreme market stress, the common FX strategies provide diversification. Well, that's it right there. During periods of extreme market stress. During periods of extreme market stress. And during periods of extreme market stress, everybody knows you run to safe haven currencies, the Swiss franc and the US dollar. Usually, not usually, but back then it used to also be the Japanese yen. Because you have three different markets. You have a European market that will run to the Swiss franc. You have a North American market, and pretty much a global market that would run to the US dollar. And you have an Asian market that would run to the yen. Well, yeah. I mean, yeah. That's been around for a long time in periods of extreme market stress. That's all. So all this is saying is something that, everybody knows, I think, is that in periods of extreme stress, money flows to safe haven places, and that is usually U.S. T-bills or JGBs or into Swiss franc. But when that's over, that's not true. So it has a regime, like every other asset class has its regime. It has its conditions under which, yes, it will be the winner. And if you're going to be in active management, it's a lot of reading the environment and saying, what conditions do we have right now? What conditions do I have or do I expect? Those are your capital market expectations. And then you'll have some time horizons, 1 year, 3 year, 5 year. And you'll set some of your portfolio to capitalize on your expectations for the next year, some of it to capitalize on the next 3, and some long-term to capitalize on the next 5. And you'll overweight or underweight particular things depending on what you expect the future to look like. Right now we have King Dollar. Well, are we going to have King Dollar in 6 months? Because if we're not, you don't want to do this kind of stuff. Are we going to have more market stress going forward or less market stress going forward? If we're going to have less, then you don't want to do this stuff. If we're going to have more, if that's what you think, then you probably want to lean into the US dollar a bit more, or lean into the safe haven currencies a bit more. So all this is saying is that, hey, we found a particular regime under which this strategy outperforms. Had they taken a different time period, they wouldn't have found those results. So as far as what I think, that's what I think. Next, it says, given those statements and the concepts of interest rate and purchasing power parity does not hold, at least the covered holds, CIRP holds, because you have a forward contract that makes it hold. Purchasing power parity does not hold in the short or medium term. You could say it holds in the long term, but everything is true in the long term. So those do not hold. A carrier value strategy seems to be pretty straightforward. Yeah, when you're in the middle of something, everything seems to be straightforward, but we cannot play where we are. We cannot play where we've come from. We have to play where we're going to. We have to play the unknown. And what is tomorrow going to be like? I mean, it's now 11 o'clock on Wednesday. I got the Fed in 3 hours. I have no idea how the day is going to end. How do I play it? Now, at 4 o'clock, you can say, well, being in defensive sectors seemed to be pretty straightforward. Yes, after 4 o'clock. That is why Kramer has his show at 6 o'clock every night, so he can sound like he really knows what's going on by telling you exactly what the market did that day. And you think, wow, that's exactly what the market did. That's amazing. That's why technical analysis is so alluring, because you look back at the chart and you say, wow, it worked every time, but it didn't. Let me show you something. Let's say that we have a stock that's doing this. It's going down. A technical analyst will say, well, here is your line of resistance. If it breaks above that line, then, that's a buy signal, and it does this. But then it does this. Well, then the technical analyst says, well, here is your line. If it breaks above that line, it's a buy signal, and the stock continues to do this. And the technical analyst goes, well, here is your line. If it breaks above that line, it's a buy signal. And then finally it does this, and it says, see, it was a buy signal because it broke out over the last line. It broke out over the last line. How many lines did they draw before it broke out over the last line? But you don't see all these lines. You only see this last line on the chart when you look backwards, and you think, well, that seemed to be a pretty obvious strategy, right? It's never obvious when you're playing the unknown. It's only obvious when you're looking backwards. Okay, we have a housing shortage and home prices are not affordable. I'm wondering why the prices of apartment REITs are not increasing. These are, equity and bond-like. They're bond-like in the sense that they have a fairly consistent coupon, being the monthly dividend if you're in Canada, or the quarterly dividend if you're in the US. And the price of any asset is equal to the present value of its future cash flows. So when interest rates are going up, the discount rate is increasing. The present value of those future cash flows tend to drop. That's all. So they're interest rate sensitive. Prior to the GICS code having an 11th sector called real estate, REITs were in financials. And what is in financials is anything that is interest rate sensitive. So if you look in the financial sector, you'll still find MREITs, mortgage REITs are still there. Equity REITs have been moved to real estate because they do have other sensitivities other than interest rate, but they are interest rate sensitive, so they will respond the same with interest rates. I'm going to combine the answer for this question with this in a second. What do you think about 6-month Treasury yields hitting the cap rate for Class A properties? Do you think this might hurt the housing market as sellers pull the trigger? And I have a question, why would they pull the trigger? For cheaper prices, out of fear they may have a hard time finding future buyers. Well, this assumes that an investment company is buying a Class A property purely just to sell it at some future point that they're actively trading it, as opposed to buying the property for its cash flow. But I'm not really sure why higher interest rates on the 6-month would, even if it's the same cap rate, would force me to sell a building that I have. I think that's what you're talking about when you're saying sellers. When you say sellers, I assume sellers of Class A properties. Well, the cap rate is, in a very simplified way, R minus G. R is your discount rate on real estate. G is the growth rate on it. We have inflation right now, so G tends to be increasing as fast as R is increasing. So cap rates do tend to be fairly stable because during the course of the business cycle, as the economy expands, R tends to increase because the risk-free rate increases, but G also tends to increase as well. So it's fairly stable. And R minus G is the net operating income divided by the property value. Net operating income is usually a series of growing cash flows, and property value over a long period of time have long-term price appreciation. How do I know that? Because properties today are worth more than they were 20 years ago. And 20 years ago, property prices were worth more than they were 20 years before that. And 20 years before that, they were worth more than they were 20 years before that, and on and on and on and on. So long term, you have price appreciation. These are all interest rate sensitive. So let me give you an analogy. You have a job, and here is your retirement age. Here you are here, and you have 30 years in here, and you're going to get a series of cash flows every year from your job, and it's a growing series of cash flows. You can always calculate the present value of all your future income, and you'll come up with a dollar amount today. You can do that by just discounting each one of these future cash flows. You can get as intricate as you want. You can find rates or extrapolate rates for every 2 weeks, or you could just take a 6-month average and pretend it's a bond that has a coupon every 6 months. However you want to model your future cash flow, you can come up with a present value. If interest rates go up while the present value of your future income drops, would you quit your job? When you buy a property, your money has a job, and your money has an income, net operating income. Just because interest rates go up, you wouldn't quit your job. Why would you make your money quit its job, right? Next one. There seems to be an increasing likelihood that China will invade Taiwan. Increasing likelihood. I guess it depends on how you want to handicap that increasing likelihood, but let's just take it for what it is. Okay, let's say there is. This could result in the U.S. at war with China. Do you have any investment strategies for that scenario should it happen? Well, this is along the lines of what Peter Zeihan has been saying, that if China is going to invade Taiwan, given their population decline at the moment, it's going to be this decade or never. He's saying that this is the last decade of China dominance because they have an imploding population problem, that in 20 years their population is going to be half of what it is today, in part because of the one-child policy and because the younger generation are simply not reproducing at a rate that makes up for the older generation that are dying, simply because that one-child policy hollowed out the population for so long that you have this huge population at the top of the age spectrum and a much smaller population at the bottom. That if China is going to do anything, it's going to be this decade, because after that it's going to have so many social and internal problems because of the population decline, it's not going to be able to afford a military to be able to do it. I would defer to Peter Zeihan on this one. He shows, this is India over here, and here's China over here. I've drawn it crudely. There's Taiwan over here. He's shown that there is a route where China gets most of its oil through a particular strait, that the U.S. can simply just sit right here and choke off that supply, and within 3 months, Peter Zeihan is saying the lights would go off in China. That would be the end of China right there. So I don't know that China can actually win a war with the U.S. I don't think that China wants a war with the U.S., and the U.S. doesn't want a war with China. And if Peter Zeihan is right, it's this decade or never. You really just have to hold them off for a couple more years. The longer you hold them off, the harder it becomes for China to do this. And if you do what Janet Yellen said on the first screen and friendshore, and you take money out of China, then you don't fuel that ideology or that ambition to be, well, let's call it colonialist with Taiwan. You don't fuel that ambition by giving them the money to back what it is that they want to do. Google this guy and go to his YouTube channel and listen to some of his presentations. Really good data. And over the past year, some of the things that he said have actually played out. And especially his analysis of population dynamics across countries. You're seeing it play out in the U.S. with the labor force participation rate. He called that a while ago. What are your thoughts about some analysts calling for the Fed to do a smaller rate hike than 75 basis points? Some analysts are calling for that. They said the Fed could be over. When you say some analysts, I don't know which analysts you're talking about. If you're talking about asset managers, well, duh, they're long. The longer you are, the more you want the Fed to stop, reverse, cut rates. Of course you do, right? They said the Fed could be overdoing the rate hikes because it takes some 1 to 2 years to affect the U.S. economy. You think people on the FOMC don't know that? It's not like he's saying something where everybody on the FOMC says, oh my God, it works with a lag? Of course they know that. They know that. They're well aware of that. 75 is in the books. 75 is going to happen. If they go 50, they will cause such a rally in yields and in equity prices that the market would then undo the very 50 basis point move they did. So they know they can't go 50. So it's a choice between 75 and 100. 75 seems like the right thing to do, and the press conference seems like a great place to shut down any rally. In fact, if I were Powell, I'd be going out there with a little earpiece in my ear with somebody in the back room telling me exactly what the market was doing while I was speaking. The market just rallied 20 points in the last 10 minutes. Then I would start to, read the riot act. Oh, we're going a lot higher. You can't believe what we're going to do. And I would talk that market down. So I'd go 75 and use very, very strong words. However, Powell is kind of a train wreck in press conferences. He goes off the rail a few times because he starts saying exactly what he's thinking as opposed to sticking to the script. So, maybe the committee knows that and says, look, man, this guy's a horror show out in press conferences. Why don't we just vote for 100 and be done with it right now? 100 would shock markets because the probability of a 100 basis point move is only 18%. You get 100, you're getting a massive sell-off today. If you get 75, you'll rally into the close unless Powell has some indication that the market is rallying during his press conference and beats the hell out of the market. In other words, he repeats Jackson Hole again and again and again to keep the market down and to keep yields high. Right now, they're where he wants them to be. Or they're where the FOMC rates are going to where they want it to be. All yields, real yields and par yields across the whole curve at all key rates, as of yesterday's close, hit the highs of the year. Every single rate is at the high of the year. The market is doing the Fed's job. The Fed doesn't want to reverse that, so I think they're going to go 75 and talk really tough. Okay, this is a really good question. I've been seeing some big market participants claiming that broad stock market returns will be in the mid-single digits for the next 5 to 10 years. This would be out of line with the historical averages that we've seen so far. The arguments that I've seen to support this are, I don't understand the first one, low interest rates compared to historical averages. I think you mean that we have had low interest rates compared to historical averages and that we won't? Or do you mean that going forward we will have low interest rates compared to historical averages? Because if you mean going forward, that doesn't support this. If you mean, well, in the past we had this, but going forward we won't, then perhaps. So I'm not quite sure about that. Low economic growth. Expected average GDP growth per year has been estimated at 2.3% over the next 10 years. This is lower than historical average GDP growth of 3.1% per year since 1948. Okay, so for this one here, is the problem with these kind of forecasts is you're standing here with the sum of all the knowledge that you know here, and your forecast is a function of the knowledge that you have. And you forecast out something. However, there is stuff that happens along here that is not in your forecast. You're not accounting for things showing up that would change your forecast. So having one simple forecast is not enough. I would have a forecast, knowing what I know now, this is my forecast. However, if A, B, or C happens, here's how it's going to change. GDP is really a function of population. The faster your population is growing, the faster GDP is growing, because all those people need to live somewhere, wear some clothes, eat some things, and do some stuff. So some people will do very well and spend more than the average person. Some people will not do very well and live below the average income, but they're still going to be spending money on something because life has an economic reality. So you can always get GDP higher by getting your population higher. So we can look at developed countries in the West and we see that population growth is really, really low. But we do know that sea levels are rising, that there are heat waves in some parts of the world where it is a risk to health, and we know that there is a massive migration from southern countries to northern countries that is happening right now. Europe has that problem, the US has that problem as people migrate up from Central South America and northern South America up through Mexico to the US, either because they're fleeing a regime that is oppressive, or there's no opportunity, or there is some economic or climate-related event that makes where they live simply not acceptable anymore. So what happens if, take the US for example, what happens if the US decides to embrace immigration at the rate of 4 or 5% per year? Think about the population growth in the US. Think of what happens to GDP growth in the US. So we're forgetting about that. The other thing that we have a hard time forecasting is changes in technology. So let's just imagine a typical Cobb-Douglas production function where Y is A, we have K alpha L 1 minus alpha, capital and labor, and this is technological progress. And as a country grows, its growth does this over time. That as you add more and more capital and more humans, you're not really going to change the growth rate of the economy. But if you lift up technological progress, you can actually get something like this. So over here, you're on a low growth trajectory, but some technology can put you back on a high growth trajectory. Well, what technology is going to happen that we can't possibly conceive of? The 1970s was this conversation as well. We are stagnant. The globe is stagnant. And then along came a lot of innovation in automobiles, and along came a lot of innovation in technology, particularly the desktop computer. And then you had, a nice run through the 80s, and then the 90s brought forth the internet. Because in the early 90s, the conversation among a lot of businesses were, where's our return to our investment in technology? It's not happening. Well, then the internet exploded, and then there was all of that. Also throughout the 80s, you had the whole field of biotechnology emerge that never existed before. Well, what industries over the next 10 years are going to emerge that we can't possibly conceive of? We have a labor shortage, but have you ever seen what robots can do these days? Have you seen the advances in robotics and AI? Well, how big are those industries going to become? How many jobs are those industries going to create? So you're going to get rid of all the long-haul truckers on the road, who will then become roofers, electricians, plumbers, masons, whatever, right? So, okay, this is based on where we are now, based on the trajectory we are, I would say, if nothing changes, this is what our future will look like. Well, sometimes dire predictions that don't work out actually had a function in a call to arms. That, hey, listen, if we do nothing, this is the future that we have in front of us, which spurs us to do something. However, you need government to be involved. So if you get an emerging industry that ends up being huge, if you get a change in immigration because there'll be no choice, some parts of the world will become uninhabitable over the next 10 years. I don't think I'm saying anything shocking, especially for some of these people that are living in those parts of the world. Look at Pakistan, look at Puerto Rico. Some parts of the world will become uninhabitable, and we're either going to have to make room or fight them at the border. What are we going to do? If we have a declining population and declining living standards because we have a declining GDP, what are you going to do? You're going to have to do something. So based on where we are with nothing changing, does this seem reasonable? Sure. But making the statement, if nothing changes, has never, ever, ever in history, well, other than the Middle Ages and medieval times, but after the Enlightenment, that's never been true. Technology moves forward all the time. It's never, ever going to stop. You don't know what new industries are going to happen over the next 10 years. And, you have countries with declining populations, but you could have countries with increasing populations if they embrace immigration. I think that is that's the big one right there. If we can overcome that, then we can get somewhere. So I'm not in the camp that future returns are going to be lower than historical averages. The future is unknown, and I will say this: there'll be something. There'll be something big over the next 10 years that creates a whole new industry, if not several industries over the next how many years. If you look back over the last 20 years, what businesses exist today that never existed 20 years ago that are huge, that are absolutely dominant? Next one. Could it be the low implied volatility is an outcome of low equity positioning from fund managers? Could be they simply do not need hedging at the margin. Well, there is a belief that the bottom is in 36.66 on the S&P. Because, some technical analyst said, hey, listen, when you have a rally that is more than 50% off a bear market bottom, that means the bottom is in. So you can draw some lines on a chart, and a lot of people will believe those lines on a chart. As I've already shown you earlier in this video, those lines on a chart are arbitrary, right? They're only lines on a chart until they're the last lines on the chart. Then they're lines on a chart. Until then, they're just best guesses to where the lines on the chart will be. But there's a thinking, well, the bottom is in 36.66. So if we're at 3,900 and I think the bottom is 36.66, maybe I'm not going to buy that much protection because I've lowered my beta. I've moved into some defensive sectors and I've rebalanced my portfolio. I've moved some into high yielding cash positions, which are paying almost 4% now. So if we do have 5% on the downside, my portfolio can handle that. And I think volatility is low because of this belief. Once this belief is threatened, volatility will spike. Okay, we have 3 questions in our first question. Number 1, could you please shed some light on the impact of the government spending on Inflation Reduction Act, CHIPS and Science Act, etc.? Would these not undermine what the Fed is trying to achieve? A lot of these bills that are introduced, these spending bills, are spread out over a number of years, so it's not as if they're going to have a big impact in the first year. I'm okay with any bill that increases capacity, because that is supply side. That's increasing supply. So as far as the CHIPS Act of getting more production on domestic soil, I'm okay with that, because that does solve a long-term problem. It does create employment. It does give a base to the economy, and it does increase supply in an area where we've seen a supply shortage dramatically increase prices and then cause bottlenecks all the way through the supply channel. Because of the shortage of semiconductors, you had a shortage of vehicles, so you had massive price inflation right across the board because of that. So as Reagan said in the early 80s, if you can increase supply, a very Austrian term is supply begets its own demand. So that is disinflationary. So there are components of it that are disinflationary, but you're doing it in an inflationary period. If the inputs to what you are building are not inflationary, in other words, there's plenty of concrete, there's plenty of steel, that's not where the inflation is occurring, then building facilities out of concrete and steel probably won't be inflationary on its own, simply because those things aren't. If that's what you're doing. If you are leaning in to a sector that is already inflationary and trying to increase capacity in an inflationary period, not only will you pay the most for that capacity, but you'll make inflation even worse in that until that supply hits the market. Then you'll get massive disinflation, if not even deflation. So doing nothing is not an option. You got to do something. And if you're doing something, do something that increases capacity or that increases supply. I'm all for that. What is the impact of higher rates on interest payments by the government? Well, what do you think, right? What's the average duration of government debt? And if the duration was to remain unchanged, how much extra the government would have to pay on the treasuries per 100 basis point rate hike? Once, let's say, a 10-year bond is issued in the market, it has a coupon that is fixed. So it does not matter what happens to interest rates at that point in time. The price of the bond will fluctuate in the market because the coupon is fixed. So it doesn't change, as far as the government debt, it doesn't change anything that was issued, a year and a half ago. So you have 10-year, 20-year, 7-year, 7-year, 5-year bonds that were issued a year and a half ago with really low coupon rates. Well, those are really low coupon rates. They stay that way. It's only newly issued debt that has the higher interest rates associated with it. So if you already have, I'm going to say 22 trillion, it's actually higher than that. But if you take the debt, the U.S. debt, and you subtract out what the Fed is holding in terms of U.S. debt, you get to about 22 trillion. Well, a lot of that 22 was issued at really, really low rates. So even though yields are going up, the interest expense on that existing debt does not change. It stays exactly the same. But what the benefit that is happening right now is you have inflation going up, so prices are going up. So any sales tax associated with prices is getting more revenue for the government. Wages are going up. So without increasing tax rates on individuals, government revenue is going up. So if you take this revenue and you pay down debt with that revenue, that's called inflating away the debt. So there is a benefit with rates going up as a result of inflation. Yes, you're going to have higher interest payments on the new debt that you issue. However, you're going to get higher revenue from the higher prices that are existing, such that it can offset those higher interest payments by paying down some debt that you don't need to reissue. So if you have a 10-year bond coming due of, let's say, 20 billion, and you only have to replace it with a $16 billion 10-year bond because you're rolling over the debt, you just lowered the debt by 4 billion. So you can pay a higher interest rate on the 16 billion that pretty much would be the same cash flow as the lower interest rate you had on the 20 billion. As far as the average duration, it's usually midterm. It's not very long duration, so they sort of have a light barbell strategy on this, where they have some short-term debt and some long-term debt, but the majority of their debt is midterm. If you go to treasurydirect.gov, and at treasurydirect.gov you can find a whole bunch of things in charts and analysis. You can find debt distribution, and you'll see that notes make up the vast majority of the debt. Bills and bonds, bills being something a year or less, bonds being 10 years or more, and notes being the intermediate term. Bills and bonds, about the same amount in outstanding debt. You can also look at it in terms of the interest payments and where the interest payments are primarily coming from. The thing that is probably most threatening right now are tips, because the principal on tips will continue to grow. You can also get what is a debt subject to limit, interest expense, and average interest rate graph. So there's a whole bunch of stuff that you can get. So I would head over to, if you're interested in looking at more of this kind of stuff in detail, go to treasurydirect.gov. Next question here. Could you please share your thoughts on oil and gas for the rest of this year and into 2023? It's not my area of expertise. I just see underinvestment there, and if you get a global recession, then you'll get a drop in demand, and maybe you'll have a balanced market. But that balanced market could be cured very easily by OPEC contracting supply as demand contracts, so that they target a $90 price, if not higher. For the next 3, 4, 5 years, I just don't see this going away. I don't see that problem going away. As we transition away from it, there is no motivation to invest in any new production. There is no motivation to do it, none whatsoever. So you're going to have a supply-constrained market for I think, a very long time, until we don't need it anymore, which will never happen, because as long as you have any kind of plastic anywhere, any kind of cosmetic, any type of chemical anywhere, any type of fertilizer anywhere, you'll never be able to move away from carbon-based products. Next, could you talk about what it would take for the Fed to get inflation down to 2%? And whether or not it's even feasible for them to do it, well, it's feasible. Of course it's feasible. I mean, you can push interest rates so high that you kill all demand everywhere, and you will fix inflation. The question is not can it be fixed, it's what is the cost of getting it fixed. And it would be a hell of a lot easier with fiscal support if you can get a government to work. But right now, and it's not just the US, Canada has shades of this as well, is that each party is motivated in making sure the other party looks as stupid as possible. That each one is concerned about their own existence and they care so little about the voter. They only pander to the voter every 2 or every 4 years. And then they tell you how wonderful they've been for you and how you're at the front of their mind all the time and that everything they're doing is for you. Yet they say stupid things because they think you're stupid. So your politicians are probably the biggest enemies right now in democracies. And I say in democracies because, we may not like authoritarian governments and we may not want to live under authoritarian governments, but over the last 15 or 20 years, democracies have proven themselves to be, I think, have more cracks in them than autocratic governments. So we've got to fix this. We've got to fix this. And who was it that said last night? It was some academic. I was watching PBS, and they said that the research they've done saying the major destruction of the social fabric over the last 10 years has been by and far social media, because social media monetizes anger. And because that's the best emotion to keep you engaged, is to get you angry. And social media has become so good at monetizing anger that he pointed to that as saying that has been the major destruction of the social fabric over the last 10 years is social media. I agree with that. If you want to find a cesspool of hate and anger, head over to Twitter. Head over to Twitter. My God. I think that company has no reason for existence, and you could probably fix a lot with democracy and a lot with the world by simply getting rid of something like that. Because here's the thing. Not everybody should have a voice. There are some people whose voice is so stupid and ridiculous that they should not even be allowed to speak on both sides. On both sides, all right? I'm not picking on one side or the other. Both sides have their crazies. And right now, the crazies dominate the conversation. It's time for both sides to stop calling each other names and look inwards into their own house and tell their crazies to get the hell out or shut up. And then maybe we can have government that works for the people who voted, as opposed to one party just trying all day long to embarrass the other party. It's ridiculous. This would be a lot easier with fiscal support. So you got to look at the Fed and you got to say, with a little bit of pity, and say, your job is not easy. I get it, because now you have to do everything because the kids aren't helping out anymore. Would you consider free cash flow a more significant factor to watch now that interest rates are up? Well, I don't know if I'd say free cash flow is more significant. It depends on the type of business that you have. There are some companies that generate huge amounts of free cash flow, and there are some companies that probably will not. Utilities are a good example of companies that, if we look at their free cash flow means the cash flow available after reinvestment in CapEx. So if you have investment in CapEx that's increasing, well, that's bullish for future growth, but it's not going to look good on free cash flow. So looking at a metric without all of the context of what that metric means, I don't know that I would just jump to free cash flow and say, aha, some businesses are better measured as a multiple of cash flow, CFO, cash flow from operations. Some are better measured as a multiple of free cash flow, especially asset-intensive businesses, because there's always reinvestment, and you need to see that reinvestment. Some businesses are better measured on price to sales. Some are better measured on price to earnings. It depends on the type of business that you're looking at, and you can value a business on multiple metrics. Just depending on the industry, some metrics are more important. For example, we don't really measure Reits based on multiples of PE. Usually you measure it on multiples of funds from operations or adjusted funds from operations. It's a better metric to measure their profitability than simply looking at their PE multiple. It's almost meaningless for the PE multiple. Okay, first question. How do you manage the weighting in your asset mix? I understand you're also buying materials in our more cyclical industries to get ready for the next cycle. However, you're also picking some defensive sectors. What are your rules when it comes to weighting? No more than X percentage in a single stock, no more than X percentage in a single sector. Also, how do you divide your portfolio between income, growth, and alternatives? I suppose a more direct question would be, what would be your personal IPS if you had the right one? As always, thank you. On YouTube, I did do a video several years back about my portfolio management approach. Also in the Applied series that I offer, there will be one section on individual portfolio management, and in there will be rules that you would think about on how you would first think about how you would manage your portfolio. So you think about, well, what is my goal? Because you always have to start with your goal, and you divide your portfolio into different categories. I need some that form income, some for growth, some for this. You know, you don't want to have 100% exposure to one single risk factor, because that's a flip of a coin. Either you're going to do well or you're not going to do well. You want a portfolio such that you have, and I've used this analogy before, farming, that you have a bunch of different fields, and you're going to plant in fields knowing that you're not going to harvest in that field for some time. So you've got a bunch of fields that are seeded, and well, now it's depending on what's going on in the market, depending on how the cycle is playing out. You may say, well, it's time to harvest this one, and in harvesting this one, I'll seed these two a little bit more and maybe seed this one here. So you have this sort of strategy. And it also depends on what stage of life that you're in and what your risk tolerance is. Some people lean way more towards low volatility and income paying stocks, even though they know that they'll outperform or underperform the broad market. They also have lower risk than the overall broad market, and they're comfortable with that. They want a little bit more than bonds, but they don't want the volatility associated with equities. So they're okay underperforming equities because they see it as outperforming bonds, not outperforming equities. So there is no one question or one answer to that question. It really comes down to you and what you want to do. But within the Applied series, there will be an overlay for that. There will be a video or a series of videos added on how to think about the rules that you want to play by, because you need rules. Usually you get in trouble when you break your rules. If you stick with your rules, if you have discipline and patience, those are the two big strategies, or the two big assets that you need to bring to the market, is discipline and patience. And if you play by your rules and you take positions that are well informed, that are leaning into the factors that you want, and you have patience, well, you can win over the long term. I understand rolling over futures contracts, but how exactly do you roll over an options contract, since the price might have fluctuated from our initial strike? Same with the futures contract, that the same strike for the next month might not be available or liquid enough. That is the problem with options, right? So let's say that you sell a call at $80 when a stock is 78, and this stock goes to 86, and you want to roll over your 80 to the next month, and you find that there's no liquidity in the 80 strike for this one. That it is a large cap stock that has options, but it's just not that liquid. A lot of consumer staples are like that as well, where the most liquid prices are just on either side of the price, and that if you go $5 or $6 out, it's not that liquid. The way I would do it is, let's say that you got $2 for this. Well, that $2 wasn't yours anyways. You didn't lose the $2 here. You're down $4. You're really only down $4. You're not down $6. So it's not as if you need to roll an 80 to an 80. Being that the 2 was never yours to begin with, you got paid $2 for it, so you can give up the 2. You don't really care. You're only down 4. I would look at rolling it to an 82 if need be. If you can't get that done and roll it to that amount, you can always combine it with, instead of going the next month, you can go out on a 60-day option and go out 2 months for an 82. There's always a way to get that done. Rolling over options, sell position does make sense since we are able to capture time value, but rolling over buy positions doesn't make sense, just adds to our costs. Yes. it does add to your cost. That if you buy a call and it expires worthless, and you buy another call and it expires worthless, you buy another call, and every time they expire worthless, it raises the break-even price that you need on the next one. So if you have the applied options course, you will learn that if you're buying options, you buy long-term options. So if you say, well, I think this is going to move in the next month, here's what happens to option premium over time. It does this. So this is a 6-month option, let's say. There's the last 30 days. Here's the first 30 days. That you don't get that much decay in the time value. So you always buy more time than what you need, because theta decays the fastest in the last 30 days. So if you are buying call options, I wouldn't look at the price of the call option and say, oh, $6 is more expensive than $3. I'll buy the $3 call option because it's a 30-day. The $6 one is 90 days. Yeah, but in 30 days, that $6 call may only be a $5 call. It may only drop to $5 if it's out of the money. So you lose $1 instead of losing $3. So you always buy more time than what you need to minimize the theta decay. So I wouldn't be rolling over month to month to month. For futures contracts, you're trying to roll over to the next month as much as possible. That's usually the strategy that you'd follow. But for options, you don't really have to do that. Instead of assignment on sell options, can't we choose to close the position at the very end at a loss, which means in that year you will have a tax loss, which is good. Take a long on the stock itself. Yeah, you can do that. So if you sell an $80 put, stock's at 83 and it drops to let's say 78, and you only got $1 on this. You could take the dollar loss and you got a tax loss of $100 per contract, and you could buy the stock at 78, and if this rises to 80, you have a $2 gain. If you allow assignment, what happens is your price on the stock that you bought is not 78 but is 79, because the $1 loss is not really a loss. It is put right into the price of the stock, so that when it goes to 80, you only have a $1 gain. If you're going to do that all within the same year, then it really doesn't matter which option you take. But if you're going to hold this for a long period of time, you're not going to recognize the loss for some time. It's probably better to close out your option, get the tax loss in that year, hold the stock for a long period of time. Now, I'm not really certain, based on tax laws, how this actually works out. That if you close this position and generate a loss for tax purposes, but then go into the stock at the same time, being that there wasn't a 60-day separation between the two, this might not be a qualified loss until you actually sell this position, which means you would have to track that. But with the forms that you get, the tax forms that you get, this idea is lost. So I'm not sure if that, because usually if you can't get out of a security to generate a loss and then get back into the same security just to generate a loss for tax purposes. Whether or not your government sees the put option and the then purchase of the underlying stock as the same transaction, well, that's a big question. And if they do, well, then you may as well just have it put to you, as opposed to you doing it yourself, because now you're going to have to track this separately yourself, whereas if you have it put to you, that's all tracked for you by your broker. When is it better to roll over short positions than take assignment? Usually I take assignment of anything I want to own. I sell puts and I sell calls on certain things, depending on my, how I feel about it. But if I want to own something, rather than buy it directly, if it has options, I'll find a way to engineer a lower price by selling a put. And that sometimes includes selling an in-the-money put. So yesterday, when Ford took its 12.5% drop in the market, I was still selling $14 puts when it was in the low 13s, because I wanted put to me, and I was able to buy it with the premium. My average price was under $13 at that time. So I was buying Ford for October expiration under 13 bucks when it was selling for over 13 bucks, and as long as it stays under 15 bucks by October, I get it. If it exceeds $15 by October, well, I get to keep all that money anyway, so I win no matter what. Okay, instead of comparing income to home prices, when you look at U.S. average new home sales price per capita disposable income, you get a 9.7% multiple. So you're looking at disposable income, which is higher than any point in 50 years. Same with looking at income. It's also the highest at any point as well. Wouldn't you agree that paints a much more clear picture on how bad housing prices are, since even if housing costs remain flat or slightly down from here, inflation in other areas would continue to apply downward pressure on disposable income, further increasing this already overextended multiple. Not sure how inflation is putting downward pressure on disposable income, because you're not using real disposable income, you're just using per capita disposable income. Disposable income is what you have left over after you pay your taxes. So I'm not sure how inflation is pushing that down. Everybody has a different tax rate, and I think that the mortgage interest tax deduction still applies, which means that your disposable income is sometimes a function of the size of your mortgage. So whenever you have a situation where you're comparing different companies that have different capital structures and different tax rates, you'll use a measure that controls for all that, like EBITDA, because EBITDA controls for the capital structure and controls for the tax rates, because you take interest expense out of the equation and you take taxes out of the equation, right? Or you use EBIT as opposed to EBITDA. You'll use EBIT, but you use some number that controls for differences in capital structure and difference for tax rates. Using income and disposable income, I think you're going to get the same relationships. You'll get different multiples, but you'll get the same relationships. It's a cleaner number to use, because then you don't have to worry about, well, what if you're in this tax bracket? What if you're in that tax bracket? And what if you're in this country where you can deduct your mortgage, but what if you're in that country where you can't deduct your mortgage interest? I just find it a cleaner number. But yeah, you can use whatever multiple you feel that the average household would use as the deciding factor as to whether or not they can afford a house. Next one, does monthly contribution of retail investors' retirement account affect the market due to systematic buy on the market? Well, not really, because that's always been there. I mean, sure, there's some buying pressure coming in every 2 weeks because of this, but pension plans also have payments that they make to retirees. Insurance companies have annuity payouts that they make every month. Property and casualty have claims that they pay every month out of their investment portfolio. Life insurance companies have payouts that they pay all the time. Investments and foundations have a spending rate, so they have to have some liquidity of 5% or more per year based on what it is they're trying to get done. So yeah, there's money flowing into the market for investments from younger people, but there's money flowing out of the market every month to go to expenses, to go to payments, to go to retirees. So what we have to look at is the net funds flow, not so much, well, money's coming into the market this way. Yeah, but there's lots of drains as well where money is flowing out of the market. So what is the net funds flow? And you'd have to look at that to determine, what the net effect on all of that would be. I've been following your options course and started paper trading along. Why will you be exiting your negative delta beta positions? Do you not believe the equity market will continue to fall? Well, it's not that I don't think it'll continue to fall. Let's just say that the market does this, and right now we have this kind of thing going on where we have rallies, we have sell-offs, we have rallies, we have sell-offs. I just don't believe the rallies. That's all. I'm not a big fan of shorting things. If I want to short something, I'll just say, well, if I think it's a terrible stock, I'll just avoid it. I'm not a big fan of shorting things, because if you're wrong, you get hurt badly. I have done it in the past where I've used options to short things, and unless you have patience and nerves of steel, things can get uncomfortable. But on rallies, I haven't believed them, because I just don't think that we're done with this cycle, with this bear cycle yet. I don't think we're done with it yet. We're not out of the woods. You can't have the bear market over before the recession even starts. That's a ridiculous statement to make. Okay, so on these kind of rallies, then I'll sell premium. Which means I'm going to sell calls on the S&P 500 because it'll lower my portfolio volatility, but I have a long portfolio. As we start selling off and getting to lower levels, I say, okay, well, this is reasonable. I don't mind being long over here. So I'm going to reduce this because this has made me money. Good enough, and it's protected my downside. And if we have further to go, okay, I'm comfortable at these levels. And at these levels, I will begin to add positive dollar delta beta. And here I'll begin to add negative dollar delta beta. And the higher we go, the more I'll get neutral. And if it keeps going higher and things are not resolved, I will get net negative. But for the most part, where we are now today, I am net positive because I do think that, further downside is... Until we see earnings, further downside is probably limited. I don't know that we get, do we get below 36.66 from where I stand right now and the visibility that I have? I think, I would have to, if I had to pick one, gun to my head, pick a yes or a no, I'd pick a no. I don't think that we get below 36.66. But that may change when I start to see earnings come in, and then I can easily add more short calls. But it's just... If I believed the rally, I would not be selling calls on the S&P. In fact, I would be leaning into the rally and adding even more positive dollar delta beta. But until I can believe the rallies, well, I just, I don't want to keep buying and selling my long positions. I don't want to keep doing that. So this selling premiums and selling calls on the S&P, that's my stabilizer. I'll sell on the way up, I'll close them on the way down. I'll sell them on the way up, close them on the way down, until when we start going up and I say, there's no reason for me to be short now. Okay, this will be the last screen that I can answer before the Fed decision. The band's already here setting up out back. So you made the observation during the early to mid-90s, despite the fact that we had elevated mortgage rates, housing prices still increased by 2.25% per year. However, when looking at the average rates year to year, it's apparent that rates were declining year over year, which would have been supportive of price growth. That is a true statement. Mortgage rates did decline over that roughly about 4 or 5 year period. Isn't the environment we're in almost fundamentally different? Not almost, it is. From a rates rate of change and direction standpoint, yep. Going from 9% down to 7% over a 4 year period versus going from 3% to 6% over a 6 month period. Different direction altogether and different speed at which we get there. So there is the pathway moving from one place to another place that we have to consider. On this pathway, you're going to get dislocation, which means the sector, and we'll just call it the housing sector, is out of equilibrium at that point. Until you get to your destination. Once you get to your destination, then expectations anchor around the final price, and then you move into a new equilibrium. The 6% that we're getting to, we keep hearing that, my God, mortgage rates are going up and up, but when we look historically, no, not really. If we look at the most recent history, the last 10 or 12 years, yeah, it is higher than the last 10 or 12 years. But if we look over, the previous 20 years before that, not really. 6% is at the lower band of what things used to be. So once we end up where we end up, and expectations begin to anchor around that number, then the housing market will settle into equilibrium, and this 6% isn't going to be as threatening at that point in time. It's the dislocation that causes a psychological reaction. Once we get to a point where that is the price, we become anchored on that price. I agree that undersupply factor can cushion price, but the rates environment seems to be more harsh than that of the 90s, even though rates aren't as high. And the housing market will be under stress until mortgage rates, mortgage rates are doing this. When you start to see mortgage rates start to do this, then we can look for a new equilibrium in the housing market and activity coming back in, because it's not going to stop. It's if anything, things may slow down until we get clarity. What matters more is the predictability of what you're going to get as opposed to the unpredictability. So if we think that mortgage rates are going to settle at 7%, let's say, and going to be at 7% for the next 4 or 5 years, then that's what they'll be. And home builders will respond to that rate. The cost of capital will adjust to that rate. Incomes will adjust to those rates, and expectations from buyers and sellers will adjust to that rate as well. And you'll have your housing market come back again. In fact, just today, I think we've seen, just this week, not just today. Today we had another number, but we had two different housing numbers that showed growth month over month. So there's only so far, given that we have such a major shortage, there's only so far down that we can go, and we will get to an equilibrium. And at an equilibrium, I think the level does matter there. Next one, curious to know your opinion about investing in tips given the current persistent inflation. I guess my question is, what is the downside of doing so? Well, the downside is that inflation over the period of time that you're holding tips is actually lower than the break-even. And if inflation is lower than the break-even rate, you would have done better holding a nominal bond as opposed to a tips bond. So that's the downside there. And if that is the case, if inflation is coming in lower than expected, the equity market is where you're going to want to be above all else. So a move towards the tips market is sort of a bearish trade on the market, because you're saying no, inflation is going to be above that break-even rate, and if it is above that break-even rate for longer, the Fed's going to keep raising rates. And as long as real rates continue to increase, well, then tips become more and more attractive. When you're talking about the squeezing of corporate margins, is it particularly for a particular sector or a specific sector, industry? Or are you talking about the whole macro scheme of things? Because companies that are able to pass through rising costs of raw materials like consumer staples should at least suffer less than other companies, right? Well, there's a limit to how much you can pass through. So if you pass through, if you have some significant price increases over a period of 2 or 3 quarters, and inflation is still persistent and rates are rising, and the aggregate level of national incomes are dropping because unemployment is rising, at some point it's going to become more and more difficult to keep passing through those costs, especially for brands. And in large cap staples, these are all brands. Because consumers can always downgrade to an off-brand item or downgrade to a no-name item. So for brands, it does become, there is a breaking point on the consumer as well. They do have more power to pass through costs, but to a certain extent. The best industry to be in for pass-through costs are utilities, because they have a guaranteed margin based on what their long-term cost of equity would be. So they can pass through whatever costs they currently have, which is why they're considered a safe haven place to be. But when I was talking about a squeezing on margins, if you have labor rates that are rising across all 11 sectors, you're going to have corporate margins being squeezed along all those sectors. And if we look at what the chart that I showed you, where corporate margins are, they've never been higher at 12%. Even the post-China into the WTO regime has a mean reverting level of 10%, and this is a mean reverting series. At some point, it's going to mean revert, and we are 12% instead of the mean reverting level of 10%, or the long-term mean reverting level of 6%, if you want to undo globalization. We do have a level of localization that is going on. So to say that we can preserve these margins would be to also argue for higher and higher inflation if we're going to preserve margins. Because if your costs go up 5%, your price has to go up by more than 5% to preserve the margin. So you're going to get inflation. Okay, the Fed decision is over. That was quite a party. Anyways, what do we have here? This screen and one more screen, we're done. Earnings season approaching. What do you think about the following theory? R&D is expensed on the income statement. Capital spending is not. Okay, well, that's always been true. Over the years, R&D has increased from a fraction of capital spending to now being significantly more than capital spending in many important industries. Data? What data are you using to support that statement? Consequently, historical valuation is no longer as valid because PE ratios have become inflated with all the R&D that is expensed as incurred. Okay, what I think you're trying to say here is that you could, let's take two companies, and we'll do a little T account here. Here are assets, here are liabilities on each company. And company one spends $500 million on assets, and they have $500 million on the asset side, and they depreciate that against income over the years, whereas company two spends $500 million on R&D and will have lower earnings right away. So that you're right, comparing the PE ratio of these two companies would not be appropriate because of you could say but the R&D is an investment in a long-term cash flow producing asset, which is whatever the output of R&D is. And if this is internally generated, you cannot then capitalize that as an asset later on until you get to the commercialization test. Then any development after that you can capitalize. So this has been around for quite some time. There are some companies that their brand has huge value just in the brand itself, but the money they spend in advertising and promotion gets expensed in the period incurred, so that they're building this intangible asset, but they don't have an asset on the balance sheet to show that it exists. So that when you look at their price to book, they appear to be valued much higher than a company that has assets. But if you look at their price to earnings, they also appear to be valued higher than the company over here. What you have to do is you have to find a metric that controls for all of that stuff, and usually companies that expense a lot of their intangible, what would otherwise be an intangible asset, you'd price them in terms of price to cash flow, some measure of cash flow. Now, when I say the data that you have for this, I don't know if this is a true statement in as much as a truer statement would be the components of the S&P 500 tend to be more asset light than they ever have before. That the asset intensity, if you look at all the companies and you combine them all into one big giant company and you add up all the assets, that the asset intensity of the S&P 500 as a whole has been declining because more tech companies are coming in, or more media companies are coming in that are asset light. Hence, they expense a lot of their intangible asset building, so that the PE would not reflect their true value. That looking at them as 15 times earnings might not be appropriate because of those huge write-offs. That they're 21 times earnings because you're pricing them more correctly on a multiple of cash flow, which then makes it appear that they have a high PE. I agree with you. So that when we look at the PE of the S&P 500 as a whole and say, well, it's at 16 point something, and historically it's ranged from as low as 12 to as high as I think 31, it's sitting in and around the 10-year average. Could it be that we have not just a PE, not just some mean reverting level, but that the mean reverting level looks more like this over time? So that you can't say, well, that if you drew the straight line, you'd say, well, this is the average is 16x, whereas from year to year it's increasing, and maybe on this particular trend the average is 18x. That's a good question. That's an interesting question, and I think that you would probably need some kind of deeper quantitative analysis behind that. I have yet to see a study that would say, given the change in the capital structure, not the capital structure, but in the asset intensity of these businesses over time, if we then went back in time and valued every company on a measure that was agnostic towards the type of assets that they had. Let's say you valued everybody based on price to cash flow from operations, not free cash flow, but just cash flow from operations. Because if you take free cash flow, well, I guess you'd have to go with free cash flow because you'd have to account for the CapEx investment. So if you price everybody based on free cash flow and you price out the market for the last 30, 40 years, what's the mean reverting level of that one? And from there, could you then adjust the PE ratio based on what that metric is saying? I don't know. That is for an academic or a PhD student. I'm just highlighting the next question I'm asking here. That's for a PhD student that has 6 months to a year to really ask a question. I'm just not that interested overall. Next, 44. Why not consider the mean reverting level from the period 2003 or 2005 to 2022, take into account that it took some time for companies to be able to move production to China, India? I'm interested to see what the mean reverting level would be taken into account. I don't know that it would change much because it kind of did this and then it went like this. So you can take out this period of time and just look at this. I think it would push the mean reverting level a little bit higher. And if it pushed the mean reverting level higher, we're at 12% right now at the top of that peak. If it did push it a little higher, we do know that we have localization. It's not like that's not happening. It is happening, and if that is happening, then this would have to come down. But you can go ahead and do that if you call up the same chart in Fred. There is a button that says download data. It'll download right into an Excel spreadsheet for you, and then you could just isolate the period of time that you want, and you can do a regression on that. It's an AR1 model, right? AR1. By the way, with this AR1, I never checked the errors. I just did it very quickly. I didn't do a really rigorous time series analysis. I just checked to see if the B1 coefficients were different from 1. They are statistically different from 1, so I know that I can rely on the output, but I didn't check the errors. If you want to be more rigorous on that one, you could, and maybe you have a nice little publication out of that to go to Seeking Alpha, or if you have a Substack, throw it on there. I have a question regarding your analysis on home price income. You mentioned that banks became much more diligent in who can get mortgages after GFC. Don't you think the lower regulations prior to GFC may have contributed to growth in housing, since more mortgage applicants were accepted? If the regulations are more strict now, don't you think the demand could in fact be lower due to rejected mortgage applications, hence restricting growth? Well, that, I think that did contribute to something in 2006, 2007. You could pretty much walk into a house and just make something up. Well, I make $100 a year. And there were no background checks. There were no checks. There were no verifications. There were no nothing. You could, depending on which mortgage underwriter you went to, they'd just write it up for you. And you can get a nice, teaser rate mortgage that was really low, and it was interest only for the first year. And the sales pitch was that come back in a year, you'll have greater equity in your home. You can actually sell your home in a year and walk away with the return on equity without paying any down payment. And the interest payment you're making is cheaper than the rent you're paying. It was alluring. It probably created more demand for homes than otherwise would have been warranted. The Austrians say, if you want to avoid the bust, avoid the booms. It's the booms that you should be most afraid of, not the busts. But if you can avoid the booms, you'd avoid the busts. If you could go back in time and avoid that, that GFC probably would never have happened. If you could have avoided that one thing and that one thing only, just all the excessive, let's call it fraud in the housing market. If you could have avoided that, then home builders wouldn't have built so much. You might not have had the supply that you had. They might have built to the market as opposed to building to an inflated market. There wouldn't have been the bust, and there wouldn't have been the lack of investment while the supply overhang cleared itself out, and we wouldn't have the supply shortage that we had today. You'd take out that volatility and you'd smooth it out. So Austrian economists do have something to say when it comes to these boom periods, is that if you can avoid that, you can avoid the bust, and that's how you reduce the volatility in the business cycle, is not trying to pick up the recession when it happens, but stopping the expansion from getting out of control. I don't know that that is politically doable in the climate that we have. Last screen. What have we got? I have a question about bonds and equities correlation and how they perform against each other. When we say bonds, let's make sure, because your question is about a correlation, let's make sure we're talking about treasuries, because once we get into corporate bonds, there always has been a positive correlation between corporate bonds and equities, and especially between high yield and equities. High yield behaves very much like equity. I remember, not 100% sure, that you said that the correlation has been mostly positive in the last 10 to 12 years. Well, actually, we could probably go 14 years. We're 2022 now. I've been reading some articles that suggest otherwise. I always hate statements like this. I read, I heard, I saw somewhere. Now defend yourself. You're saying this, and I read, I heard, I saw somewhere the opposite. Defend yourself. Well, if you're going to do this, you got to give me the source. Who's saying it? When did they say it? What is their credibility? What is their background? Are you sure that's what they said? Did you read it correctly? Are you missing some words? Are you repeating it correctly? I'm asked to accept a lot when somebody says, you said X, and I heard, I read, I saw somewhere Y. Defend yourself. Well, if you can't remember where you read it and who wrote it and what you saw, how can I rely on the fact that you're actually repeating it correctly? You see where I'm going with this? I'm not trying to give you a hard time here. I'm just saying that whenever you ask a question, especially in this industry, especially in finance, and especially when you're talking to other analysts and to other professionals, whenever you say, I read, I heard, I saw somewhere, you will be discounted. Always have your source material. Always have your reference available. So-and-so said this in this context, and always provide the link for that so that the person can then refer to it and then at least be in a position to say, okay, well, here's the premise that they were speaking under, and here's what I was saying. But with this one, I'm blind. So just as it will make you, I think, more informed if you want an answer from someone. If you say, look, what you said is different what you said is different than my understanding of what this person is saying over here. Here's the link. Let's see. Most of them, again, I don't know the thems, said the correlation is mostly negative except in some special times. Could you cover this in your Q&A or send me some links about this problem? Well, for treasuries, the thinking is that it has beta equal to 0, that it really has no market exposure at all, which makes it uncorrelated with equities, because equities have a very large beta component. Now, some equities do have an interest rate component. So you can take Reits, for example. Apartment Reits are probably very highly correlated with treasuries. As interest rates go up, treasury prices go down, and apartment REITs would go down because they are interest rate sensitive. But as a whole, typically, you'd get almost almost zero correlation or a slight negative correlation. So just a quick lesson on correlation. It ranges from 1 to -1. When you find an asset with a correlation of 1, you have what is called perfect replication. That is a perfect replication. So let's take stock ABC and you use options to create a synthetic. Well, they will have a correlation of 1. A correlation of -1 is called a perfect hedge. Right? So if you have stock ABC and you're long and you create a synthetic short, you will have a correlation of -1. You have a perfect hedge. Correlation of 0 is a perfectly uncorrelated. This is maximum diversification, by the way. Most people think that no, the more negative you get, the more diversified you get. No, the more negative you get, the more hedged you get, in which case you have nothing. You're not diversified, you have nothing. Treasuries used to be in around here like -0.1. But after the great financial crisis, interest rates were lowered to nothing, so bonds rallied. And that created the environment for equities to rally. And it was that way for such a long period of time that as interest rates started to rise, well, interest rates up, bond prices down. However, that also created an environment in which people believe that, well, equities are going to drop as well. Once we get to a point where you have some equilibrium in rates, where we have some visibility that rates are going to be stable for a period of time, we may get that negative correlation again. I don't know, but we may get it. But it was negatively correlated for a long period of time. When we say it's negatively correlated, it depends on the time period that you look at. So if we look at, let's say, 96 to 99, you might find during that period of time a positive correlation. because treasury rates were dropping, treasury prices were increasing, but the stock market was increasing. So it's not as if it always works that way. Where the negative correlation comes in is at extreme points. So let me do a business cycle down here. In a contraction, equity prices are dropping, but the central bank is lowering interest rates, so bonds are rallying, right? And at the peak up here, equities are in a bull market, but inflation is showing up, so interest rates are rising, bonds are dropping. So here and here, if you just took these periods in time, you know, the 4 or 5 quarters before the slowdown and the 4 or 5 quarters after the contraction, and you just looked at that, you'd probably still find a negative correlation between them. But I think somewhere in here, you know, the correlation becomes less negative, maybe even slightly positive, depending on what the central bank is doing with rates, because rates may be held low for a period of time, or they may still be dropping. If the economy is doing this, performing under trend, well, rates may drop to get the economy to perform more in trend, which would be bullish for equities, but rates dropping would also be bullish for bonds. So I don't know if that relationship is going to revert back, but the thinking is that they were unrelated. But if they have a common factor now, which is the economy performing below trend, then they will be positively correlated for some time, because the central bank, you know, once we get past the inflation issue, the central bank will try to engineer an economy that will perform higher than below trend, which is going to be supportive of bond prices, which is going to be supportive of equity prices. So I don't know if we go back. Next one, I have a question pertaining to S&P 500 valuation generally. Frequently in your videos, you look at the PE of the S&P 500, make a determination of reasonable valuation for the coming period. Usually it seems like the determination is based in part off some historical look-back period of where it's traded in the past. Pretty much, yeah. Is there a way to provide a valuation for where the S&P should be trading based on the fundamentals? I'm thinking specifically of the justified PE ratio used to value individual securities. Would it be reasonable or possible to apply the same model to the index as a whole? Well, I don't know why not. You could just take the 500 stocks in the index and combine them all and say, look, I'm going to pretend for now this is just one big giant diversified company. And you could do the same thing. Probably a better way to look at it is in terms of what you're getting paid for risk. So take the PE, 1 divided by the PE ratio. This is just E over P, by the way. 1 divided by the PE, if you're doing that, you just take the denominator and invert it. That's E over P. E over P, which is an earnings yield on the index. And subtract the risk-free rate. You could subtract whatever risk-free rate you want. If you want to be consistent with CAPM, you can subtract the 20-year. However, the 20-year is abnormal on the yield curve right now, because you have a yield curve that looks like this. It slopes down into the 10. The 20 pops up and the 30 comes back down. That's an outlier. I don't know why more money isn't going into the 20-year at this point. I guess, you know, it's not long enough for the insurance companies, and it's got way too much duration for everything else, so there's not that much interest in the 20-year, but it is an outlier. So you might want to take the 10-year. You can subtract the 10-year. That would be consistent with CAPM. Or you can subtract a 3-month risk-free rate, which would be consistent with FAMA French. And this will give you an equity risk premium, ERP. And you can look at that and ask yourself if it makes sense to buy the market with an equity risk premium at that level right then and there. So E over P, if we say it's got, I'll do it on the fly here and we'll see what we get to. We're about 16.5. So if you take 1 divided by 16.5, you get 6.06%. Let me make some room here. You get 6.06%. Now subtract the risk-free rate, and let's say we're going to take off let's just take off the cash rate. How's that? We know now it's 3.25. Actually, we shouldn't do that. Let's take off a 3-month rate. Let's call it 3.8%. You get 2.2% on the equity risk premium. If if we look at historical levels of the equity risk premium, which we can do, that's agnostic to any asset intensity. It's agnostic to any capital structure. If we look at historical equity risk premiums of anywhere around 4 to 4.5%, and let's say that we want 4% on the equity risk premium, it's paying 2.2. It is too high right now. So what is going to make it attractive? Well, this has to drop. So if this dropped to 2%, if the 3-month yield dropped to 2% and the index was at 16 times earnings, well, there you go. Or this would have to increase 180 basis points, and this would have to increase to 7.86%. Well, you can do the calculation to figure out what the multiple would be given what we know now. So 1 divided by 0.078, we would get 12.8 times. You'd need a multiple of 12.8 on the index, given that the risk-free rate is at 3.8 to get an equity risk premium of 4. So there is an interesting way to price it. So it's a matter of, now because we're not investing for today, we're investing, here we are today, this is today. We're investing over this period of time, so you have to say, well, hang on a second. Over a period of time, I'm not going to look at the rate today. What do I think it's going to be over a period of time? And being that the Fed has given us their summary of economic projections and the dot plot, we can look out a period of time and we can have some rate that we expect over some investment horizon. And then what we can do with this is say, well, what do we expect to happen over this period of time? So we'd forecast out earnings and what would earnings be over this period of time. And, you'd have to have some kind of forecast going forward, and then you determine whether or not this horizon period had a 4% ERP. But in buying today, you're buying knowing that currently the market is justifying a 2.2, or implied, I shouldn't say justifying, it's an implied equity risk premium of 2.2%. Now, if you think rates are going to drop, well, then the equity risk premium is going to increase. I don't think that's going to happen. So being that I don't think this is going to go down anytime soon, this is going to have to go up. And for this to go up, the numerator has to go down. Now, if you get earnings this season dropping, and this 6% has to go to 8%, and you get earnings dropping, price is going to have to go down even more than just a little bit. Anyways, on that happy note, we'll end here.